Welcome to our investment philosophy summary video. I'm Jeremy Epley, certified financial planner, accredited portfolio management advisor, and founder of Silverstone Financial. Now, everyone has an opinion on the best way for you to invest your money. From get rich quick schemes that you can find on the internet to hedge funds touting their proprietary trading algorithms. Well, at Silverstone Financial, we believe in time tested, common sense, and evidence based investing strategies. That's why we describe our investment management with these three terms: passive, factor based, and direct indexing. Let's break down each of those terms, starting with passive. Now, active versus passive investing is an age old debate in finance. You can find plenty of evidence online supporting either side. However, the majority of academic research shows that in most cases, long term passive investing leads to higher returns over active investing. But passive investing is a broad term. What do I mean by that? Well, traditional passive investing usually is simply investing in a market cap weighted index fund, like an S&P 500 ETF or a total market mutual fund. There are two main problems with this approach. The first problem with a total market index approach is that these funds are market cap weighted, which means more money goes into larger companies rather than into smaller companies. This leads your portfolio to not actually being particularly diversified. Using the S&P 500 as an example, 1/3 of the index is just in the top 10 stocks. Now that's a lot of your money in quite a concentrated position, very few names. It can be a problem. The second problem with a total market index approach is that you end up buying every stock on the market, regardless of whether or not the stock is actually a good investment. So that brings us to our second term to describe our investment management style: factor based. Since not all stocks in a total market index fund are good investments, we believe that by using rules-based, unbiased financial screening criteria, that we can be more discerning investors. This is called factor-based investing. The specific kind of factor-based investing that we subscribe to is called growth at a reasonable price investing, or GARP investing for short. Now, the exact methodology to determine whether or not a stock is considered to be a GARP stock is explained in detail on our website, but I'll give you a brief summary of the strategy here. Let's use the S&P 500 as an example. You start with 500 stocks. Some of them are great stocks, some are good ones, some are average ones, and unfortunately, there are going to be some bad stocks in that mix. Now, using a growth at a reasonable price filter takes two steps of analysis. First, you rank all 500 stocks by their past 3-year earnings and sales growth, and then eliminate the bottom 70% of stocks. By doing this, you would be dropping the bottom 350 average growth and below average growth companies and not investing in them. Then you re-rank the remaining 150 stocks by various financial ratios, like their price to earnings ratio and others, to determine their composite quality and value score. You would then, again, drop the bottom half of the remaining stocks. That would equate to eliminating 75 high growth companies. But the problem with those 75 companies, the bottom ones, is that they either had low quality balance sheets or were overly expensive for their growth. After all that, you'd be left with the top 15% of stocks from the original total market index that would meet the growth at a reasonable price criteria. By eliminating the bottom 85% of stocks in an unbiased mathematical way, you can replace the traditional total market index approach of just buy everything and hope for the best, and employ an approach of buy only the best instead. Finally, that brings us to our third term: direct indexing. Now, direct indexing is where you directly invest in the underlying stocks held within an index instead of an exchange traded fund or a mutual fund that holds them for you. Historically, direct indexing was only available to those with accounts worth like $500,000 or more. But our technology platform utilizes fractional shares to allow for direct indexing in accounts as small as $1,000 or $2,000. It's unheard of just even a few years ago. Now, there are a lot of benefits to direct indexing. The first main one is that it, of course, eliminates the fees charged by fund providers. Some specialty index funds, like GARP index funds, can charge as much as 20 or 30 or 50 or more basis points as their expense ratio. That's 0.5% if it's 50 basis points. Now, we already charge an investment management fee as an investment management advisor, and we feel that you shouldn't have to pay an additional layer of fees to an ETF or mutual fund provider if you don't have to. Now, our direct indexing allows you to hold individual stocks, which doesn't cost anything to hold them. So you aren't being charged an extra fee by those fund providers acting as middlemen, holding those funds for you. Now, the second main benefit of direct indexing is something called tax loss harvesting. Now, tax loss harvesting is where you systematically sell the lowest performing stocks in an index, because there's always going to be some high performing, some low performing stocks in that index, and then rebuy those stocks after the required waiting period. By doing this, you can lock in permanently those tax losses and offset your gains. Even though those losses were temporary, you get to lock them in to be permanent. Because stocks fluctuate every day, by not doing this, you miss out on capturing those losses, leading to an overall higher tax burden on your portfolio. See, tax loss harvesting can dramatically increase the tax efficiency of your portfolio. And we do this for you automatically, so you don't need to worry about it. Well, I want to thank everyone for listening to my brief summary of our investment philosophy. If you want to learn more, you can reach out to me, or you can explore the investment philosophy page on our website, where you can see our methodology, review our investment portfolio allocations, take our free personalized risk assessment questionnaire to determine your specific risk number, or directly schedule a meeting with us to review your financial situation one-on-one with a financial planner. I want to thank you in advance, and I look forward to meeting you.